IRS audits, the very word can evoke a sense of dread, anxiety, even terror. In fact, for many people, getting audited and chased down by the IRS is their single biggest financial fear. Listen, despite the fact that millions of people are terrified of IRS audits, a lot of people have no idea what their chances of an IRS audit actually are. So guess what I'm gonna do? In today's video, I'm gonna remove all of the mystery surrounding your chances of an audit, especially if you make less than $300,000 per year. Without further ado, let's dive in. All right, let's discuss what factors go into an IRS audit. First, it's your income. When the IRS decides whether or not they're going to audit somebody, certain income groups are more likely to be targeted for an audit than others. High income earners are frequently targeted by the IRS. And the reason why this is the case is because typically, if the IRS finds errors, omissions, or outright lies on the tax return of wealthy taxpayers, it's going to be able to recoup a larger amount of money through those fees, penalties, and additional tax payments than it would if it was a taxpayer that was making less money. In other words, a small mistake on a tax return of a billionaire could be worth millions of dollars. But a small mistake on a tax return for someone who's making $50,000 might only be worth a few $100s to the IRS. So it can be a better use of the IRS's resources for them to focus on higher income earners. But this doesn't mean that the IRS doesn't audit people who are not high income earners, because it definitely does. So don't make this mistake of thinking that just because you don't make a whole lot of money, that you can mess around with your tax returns and be dishonest with them just so you can end up in an IRS audit and give them more money. In fact, low-income wage earners who take the earned income tax credit are another group that is frequently targeted by the IRS for audits. The next thing that you have to consider is the types of reporting on your tax returns. There are many different ways that people report income, and the way that you report your income will depend on how you make your income. For example, sole proprietors, self-employed individuals, single-member LLCs, they report their income on a Schedule C. If you're self-employed and if you report your business income on a Schedule C, then this by itself can increase your audit risk. And this is because self-employed people often try to claim a wide variety of business expenses, and generally speaking, their returns are just more complicated than the returns of a traditional W-2 employee. If you happen to report your income in ways that the IRS is more interested in looking at, such as using the Schedule C, then this can definitely increase the odds of you being audited on a year-in and a year-out basis. Number 3 is red flags. Red flags are details in your tax return that the IRS might find to be unusual or suspicious. Anything that deviates from the details of a normal or non-suspicious tax return can be considered a red flag to the IRS. This can include large amount of Schedule C losses, extremely large home office deductions, missing information, and the list goes on. If you're a business owner and if your business does large amounts of cash transactions, such as restaurants, cannabis dispensaries, beauty salons, barbershops, food trucks, then this can also increase your chances of an IRS audit. This one's easy. The reason why is because the IRS knows that many people with cash-heavy businesses often forget to report all the cash from their business. Another thing that can be a red flag is if the IRS notices that there is some sort of major discrepancy between the documents it received detailing your income versus the income that you actually reported. So for example, let's say you made $100,000 trading stocks online, but you only reported that you made $50,000. Then this can be a huge red flag and a big problem, but here's how. Don't forget, if you make money on an online trading platform like Robinhood, E-Trade, then these companies are required to send an IRS form called a 1099-B to report your earnings. So just be aware of this. If the IRS notices that you report significantly less income than the reporting documents that were claimed by these institutions, then this is definitely going to increase your audit risk. Now, what are the chances of being audited if you make less than $300,000? The first thing that you need to know about the actual risk percentages for audits by income is that they actually change every single year. And what I mean by this is that the IRS does not audit the same exact number of people every single year. A number of variables impacts the amount of people that are actually going to be audited on a year-in and year-out basis. For example, the IRS has a year when a large number of its employees retire, and this can result in lower audit rates. If the IRS hires and trains more staff or decides to be more aggressive, then this can increase audit rates. In 2022, roughly 164 million tax returns were filed, and the IRS audited 626,204. This translated to an audit risk of approximately 0.38% for all tax filers. However, despite the fact that this was the overall risk for all tax filers, as I mentioned earlier, some tax filers have a much higher chance of being audited. If you made between $200,000 and $300,000 and you did not use a Schedule C, then your audit risk would have been 0.49%, which is significantly higher than the overall average of 0.38%. If your income was in the range, but if you did use a Schedule C, then the risk would have been even higher, 1.03%. So as you can see, just like I mentioned earlier, using a Schedule C can significantly increase your odds of being audited. For this income group, it is more than double the odds of an audit. But if your income was under $200,000 and if you were not a low earner taking the earned income tax credit, then your audit risk was just 0.19%. The majority of Americans actually fall into this category. And so for this category of people making under $200,000, roughly 1.9 people out of 1,000 are getting audited. Now, if you do fall into the category in which you are an extremely low income earner, making less than $25,000 per year, and if you are taking the earned income tax credit, then your chances of an audit are going to be significantly higher than they are for most people making under $300,000. In fact, in 2022, people who fell into this category were audited at rates of 1.27%. Only people who made more than $1 million were audited at higher rates than this in 2022. So this is why it's so interesting to study this stuff. Now, that was a lot of information and data that I just threw at you. So I'm going to quickly go over it again to make sure that you can process all of this information. Let's jump into the iPad. So if you make less than $25,000 a year, you're probably taking their earned income tax credit. So that means that your audit risk is going to be roughly 1.27%. Okay. Now, if you're making under $200,000 and you do not take the earned income tax credit, then your audit risk is only 0.19%. But what if you're making between $200,000 and $300,000 and you do not use a Schedule C? So no Schedule C, then your audit risk drops to 0.49%. And if you're making between $200,000 and $300,000 with a Schedule C, then your audit risk actually goes up to 1.03%. So as you can see, your audit risk increases greatly by using a Schedule C. The bottom line is that a vast majority of people making under $300,000 per year, including all of you watching this video who make less than this amount, are simply not going to be audited by the IRS. But around 0.2% to 1.3% of you will, okay? So if you have any of the red flags that I mentioned earlier, such as high deductions, discrepancies on your tax returns, you're reporting income wrong, reporting a lot of cash, then the chances of you being audited will be significantly higher than normal. So even though the odds of you being audited might be low, it is definitely still possible. Also, you have to keep in mind that the IRS was recently approved to increase its budget by over $80 billion over the next 10 years, and that a large percent of this money is actually earmarked for law enforcement. So the number of audits that we're gonna see are probably gonna go up. But you're probably wondering, how do I decrease my audit risk? Now, I know a lot of you right now are asking me, Karlton, is there anything that you can teach me right now that will just help me fly a little bit more under the radar, help me reduce my audit risk? Well, as I promised at the beginning of this video, I'm going to give you a few tips on how to decrease your audit risk so you can best protect yourself. Here are those 3 things that you can do right now to decrease your audit risk, and I hope that you take these seriously. Number 1, make sure that you don't have any missing income on your tax returns. I know it sounds crazy, but so many times business owners forget to report all of their income. And when I say this, I'm not just talking about you W-2 taxpayers or 1099 income from your job or business. I'm talking about your capital gain income from the sale of stocks, your dividend income, your interest, your crypto stakings, your crypto rewards, your royalties. The IRS requires you to report all of this income, and a failure to report even a small percentage of it can result in Uncle Sam chasing you down and auditing you. Number 2, do not inflate or over-exaggerate the size of your home office deduction if you're self-employed. You see, taking extremely large home office deductions is a red flag for the IRS. The home office deduction is based on the size of your home office, and it's in proportion to the rest of your house. So if you have a 6-bedroom house and you're stating that over 60% of your house is used for business, this could kind of lead to the IRS getting suspicious. So beware of overestimating your home office deduction or really any other large deductions that you're thinking about claiming. And number 3, use a tax preparer rather than utilizing your own tax software. Now, most likely, a lot of you guys are already working with a CPA or a tax firm that's filing your tax returns, but there's still a number of you guys that are following me that file your own tax returns. If you do not do taxes for a living, the chances of you increasing your audit risk instantly go up because you don't understand taxes and you're letting the software solve these problems for you. If you do your own taxes manually and do not use the help of a tax preparer, or you're using some type of tax preparation software, then this can increase the odds of you making mistakes, such as accidentally claiming losses that are higher than your true losses, or making math errors on your returns, or omitting information that you should have put inside the return. If your tax return has errors and it gets flagged as a result, then this will increase your chances of being audited, point blank period. So if you are still doing your taxes manually and you choose to go around a CPA and hire an advisor, you're automatically increasing your audit risk. No one wants to get an IRS audit. I have no one that I've ever talked to that was excited about it. And if you're currently undergoing an IRS audit, then I feel for you right now. But most likely the IRS is not going to go away anytime soon. So all of us have to deal with IRS sometime, one or another, and we need to make sure that we're limiting our risk. This video has been mostly about statistics and data, and we covered audit risk for income earners who are making less than $300,000. But here's some basic information about audit risk that I want you to walk away with from this video. For most people in America, the risk of being audited is going to be less than 1%. I mean, it gives you some peace of mind, doesn't it? However, if you're a low income earner and you're taking the earned income tax credit like I talked about earlier, then you have a higher risk of an audit coming your way. So please make sure that you're doing this correctly and you're not abusing this tax credit that the government is giving you. You can reduce your risk of an audit by reporting all of your income correctly and not over-exaggerating your losses, not over-exaggerating your deductions, and working with a professional tax and accounting preparation firm, not just using tax software that you got offline. This helps you reduce your audit risk and helps you reduce making errors. If you have any questions about IRS audits, or if you need assistance in minimizing your audit risk, then feel free to get in touch with my team today. You can do so by clicking on the link below in the description. You can also find a link to my Tax Alchemy course. This course is where I teach you how to use the same tax strategies that the most savviest of Americans are using to slash their tax bill in half or even lower. So if you're serious about reducing your tax burden, I look forward to seeing you inside of my course, and I look forward to seeing you inside of my online coaching calls with my other students. Finally, there's also a link in the description to get in touch with my real estate tax team. If you need help with your personal real estate tax situation, for example, you need help going through a 1031 exchange, you need help running a cost segregation study analysis, identifying a property for depreciation purposes, then check out my links below, and you would love working with my team because we focus on helping taxpayers buy real estate to offset W-2 and 1099 income. Thank you guys so much for joining me on this video. I look forward to seeing all of you guys on the next one. Cheers.